You are listening to The Vocal Technologist. Spoken Tech for your ears.
Welcome. If the sheer speed of the Web3 space feels like trying to drink from a fire hose, one day it's a policy reversal at a major bank, the next, it's a massive network upgrade you can barely pronounce. Don't worry.
Oh, it's a lot.
It is a lot. But we're going to give you the signal today. We're taking a hard look at what's been happening, and the core finding is this. Wall Street isn't just, experimenting with crypto anymore.
No.
They are now actively positioning it as their top future financial engine.
That's the critical takeaway. Our mission here is to synthesize everything for you. We're connecting the institutional market shifts, the actual money flows, to the underlying technological revolutions that make them possible.
And the regulatory side, too.
And examining the global regulatory boundaries being redrawn in real time. Yeah. You really need to understand how tightly integrated these forces are right now.
Okay, let's unpack this institutional pivot, starting with the firm whose enthusiasm has been, well, most contagious. I'm talking about BlackRock. They manage north of 1,400 exchange-traded funds, holding a staggering, $13.4 trillion in total assets globally.
It's a mind-boggling number.
But look at their Bitcoin ETF, IBIT. It somehow became their single top revenue source. That still seems unbelievable to me, given their scale.
It just speaks volumes about the speed of adoption. IBIT launched in January 2024, and in record 341 days, it hit $70 billion in assets.
Just incredible.
It now sits at $70.7 billion, and that was fueled by net inflows exceeding $52 billion in its first year alone.
Wow.
That phenomenal scale translates directly into estimated annual fees of around $245 million by year end.
That fee number is astonishing, but I have to ask, is this real net growth for the system, or are they just cannibalizing the existing crypto ecosystem, eating into the market share of established exchanges or private custody providers?
It's both, but the scale really points toward net new demand. I mean, when BlackRock adopts Bitcoin, it's not a short-term trade.
Right.
It's a strategic core offering that pulls in capital that was previously locked out by compliance or, fiduciary limits.
Well, we're seeing proof of that.
The evidence of broader appetite is clear. Just recently, both spot BTC and Ether ETFs broke multi-week outflow streaks after Thanksgiving. They recorded their first positive inflow streak since October. This institutional money is consistent. It's not cyclical.
And BlackRock's success has created, immense pressure on every major competitor. That brings us to Bank of America.
Yeah.
For years, they were extremely cautious, basically telling wealth management advisors, no crypto, period. What's changed?
The dam has officially broken. BofA just executed a pretty significant policy reversal.
Oh, they're in.
They're in. They now allow their wealth management advisors to recommend crypto allocations to clients. This is huge because they previously carry one of the industry's most restrictive policies.
So what's the new range they can recommend?
Yeah.
And how do they justify it?
Advisors can now recommend between 1% and 4% crypto exposure. The justification is rooted in risk profiling and this idea of thematic innovation. The lower 1% is positioned for a conservative, risk-off investor who just wants minimal exposure to the category.
Yeah, the 4%.
The higher end, up to 4%, is for clients with a high volatility tolerance who genuinely believe in the long-term Web3 technology story.
So by doing this, they're catching up.
By doing this, BofA aligns itself with Morgan Stanley and BlackRock, putting intense pressure on the remaining major holdouts like Wells Fargo and Goldman Sachs to follow suit.
So we've established that institutional money is pouring in to hold these assets. But the real friction point, the real utility, comes when they start using the blockchain rails for practical day-to-day payments.
Exactly.
We're shifting from assets on the balance sheet to global financial plumbing.
Exactly. And Visa's expansion demonstrates this pivot from asset class to utility. They partnered with a company called Aquanow to expand stablecoin settlement across EMEA.
So Europe, the Middle East, and Africa.
Yep, Europe, Middle East, Africa.
And what problem are they actually solving there? Because, banks already move money.
They are solving the 365-day problem. Traditional banking rails, they grind to a halt on weekends and holidays.
Right, the 9-to-5 problem.
Visa, using approved stablecoins like USDC, is enabling 365-day settlement. It completely eliminates those frustrating delays for cross-border transactions.
That's a massive improvement in speed and efficiency. What kind of volumes are we talking about?
They are already operating at a $2.5 billion annualized run rate for stablecoin settlement.
Wow.
And they plan to add 4 more stablecoins across 4 different blockchains. That's hard proof that stablecoins are solving tangible cross-border friction points.
And we're seeing it elsewhere, too.
We see this mirrored in remittances, too. MoneyGram partnered with Fireblocks to power stablecoin payments across more than 200 countries.
So for MoneyGram, what's the benefit?
For them, this reduces the requirement to pre-fund accounts in volatile foreign currencies. And for the customer, it enables near-instant digital wallet arrivals using USDC.
That's infrastructure for institutions. But what about the person on the street spending their money? The non-custodial card launch in El Salvador. That caught my eye.
That's a crucial case study for true adoption. On January 29th, a non-custodial USDT Visa card is launching there.
Okay.
This card allows real-time spending directly from a user's self-custody wallet running on the Polygon network.
So the key is you hold your own keys.
The key is that the user never has to preload a custodial account or trust a third party. When you buy a coffee, the funds are drawn directly from your wallet at that very point of purchase.
No middleman.
It eliminates middlemen. They charge a 2% conversion fee, but for true self-sovereignty and instant spending, many users are willing to pay that.
Speaking of self-sovereignty in the stablecoin market, we have to spend a moment on Tether, the largest player by far.
We do?
They are essentially running one of the world's largest macro interest rate trades right now.
They are. Tether is actively accumulating Bitcoin and gold, basically hedging against the anticipated Fed rate cuts that would otherwise cut into their interest income.
From all those treasuries they hold.
From their massive holdings of U.S. treasuries. But what's often misunderstood is the sheer financial resilience of the operation.
Explain that resilience.
Well, while most people focus on their disclosed reserves, Tether maintains a separate, large, undisclosed equity balance sheet.
Okay.
They generate an estimated $10 billion in annual profits, derived from holding about $120 billion in treasuries, which yield around 4%.
So that profit just gets added to the pile?
That annual profit is added to the equity buffer, which is currently estimated to be between $50 and $100 billion.
So that equity is essentially a massive hidden cushion.
Precisely. It's a huge, sellable buffer designed to cover any catastrophic gap in their balance sheet. Think about the fractional reserve system that traditional banks operate on.
Right.
Most banks run with collateralization of only 5 to 15%. Tether, because of this massive equity buffer, operates at significantly higher collateralization levels.
So they're functioning like a bank, but a much safer one in some ways.
This structure means Tether functions less like a money transmitter and more like an unregulated, hyper-collateralized bank. They're a systemic financial player, whether regulators choose to acknowledge it or not.
That is a powerful financial engine. But that engine needs robust, high-speed infrastructure, a freeway to run on. We've talked about the market and the payment rails. Now let's shift to the deep technology,
Right.
how the foundation itself is scaling up. Ethereum just underwent its 17th major upgrade, known as Fusaka.
Fusaka just went live, and it's the first step in a new, aggressive, planned, twice-a-year hard fork schedule for Ethereum.
So more upgrades, faster.
The goal is pure capacity expansion.
Yeah.
It massively expands data availability and boosts the block gas limit from 36 million to 60 million.
Let's slow down on the tech for a moment. For the listener, we hear terms like layer 2 or roll-ups constantly. What exactly are those, and what is Fusaka doing for them?
So think of the main Ethereum network, the layer 1, as the foundation or like the judicial system. It provides ultimate security and settlement.
Okay, the base layer.
The layer 2s, or roll-ups, are the high-speed transit lanes built on top of that foundation. They process transactions faster and cheaper, and then they batch all that data and commit it back to the layer 1 for security.
Got it. And the specific tech in Fusaka is called PeerDAS. Is that the long-promised sharding everyone talked about years ago?
In principle, yes.
Yeah.
It's the core scaling breakthrough. Before Fusaka, the roll-ups would dump these huge data blobs, just chunks of transaction data, onto the layer 1.
And every node had to store everything.
Every single node had to store the entire blob. PeerDAS changes that. Instead of every node storing the full data, nodes only store a small, verifiable slice of every block.
So it's like cutting a loaf of bread into slices and requiring different bakeries to hold different slices, but still allowing anyone to verify the whole loaf existed.
That's a great analogy. They can still verify the full data exists, but the storage burden is dramatically reduced. This is why it's a massive scaling win.
And what's the bottom line?
It allows layer 2 networks to safely scale up to 8 times their current data capacity, which means those layer 2 transactions become significantly cheaper for you, the user.
Lower fees are fantastic, but this raises a serious economic question about ETH itself. We know that since EIP 1559, which introduced the fee burn mechanism, about, what, $12 billion worth of ETH has been removed from circulation?
A huge amount.
If block space gets cheaper with Fusaka, does that mean the network becomes inflationary again because less ETH is being burned per transaction?
This is the critical Fusaka supply experiment. It's being watched by real-time tracking tools like ETHFall. You're right, if transactions are cheaper, the base fee burn per transaction is lower.
So what's the other side of that coin?
The dynamic tension is whether the massive increase in activity pulled in by the cheaper block space will ensure that the total number of transactions is so high that the overall burn still outpaces the rate of new ETH issuance. It's a high-stakes balancing act.
And while the base layer is getting more efficient, the debate over where the value accrues continues. ETH has underperformed Bitcoin recently. Why isn't all this engineering success flowing directly to the L1's token price?
What's fascinating here is that the economic activity is diverging from the security layer. Growth is exploding on the L2s, but the majority of the transactional fees and the maximal extractable value, or MEV.
Which is basically the profit from reordering transactions.
Exactly. That's captured largely by the L2 sequencers.
And who are these sequencers?
Often, they're centralized entities like Coinbase. Arbitrum, a major layer 2, showed this immediately after the upgrade. Median fees briefly spiked to about 99 cents.
So demand just flooded in.
Demand immediately flooded that new capacity before settling back down. This illustrates that while the Layer 1 provides the security, a huge portion of the profitable economic activity is happening on those fast lanes, captured by centralized intermediaries there.
Okay, now we have to move to the edge of risk. Any innovation managing trillions in value brings proportional threats, and we need to talk about the guardrails and the predators, starting with AI. This sounds like the start of a technological arms race.
It is. AI is now an immediate operational threat to code security. Researchers at Anthropic ran some, frankly, terrifying tests using their attack agents models like Claude 4.5 and GPT-5 against live, but sandboxed smart contracts.
And the results were alarming, weren't they?
They were. The AI agents autonomously managed to exploit 17 of 34 recent real-world hacks that had occurred on public chains.
So they replicated existing hacks.
They replicated them, stealing simulated funds. Even more worrying, when pointed at a large batch of fresh contracts with no known bugs, the AI agents managed to find 2 new vulnerabilities and exploit them.
Wow.
The core message is clear. AI makes finding, chaining, and executing classic contract exploits incredibly cheap and fast. You could replicate a year's worth of human auditor work in a weekend.
If the tech is getting smarter, the regulatory environment has to get clearer. Let's look at 2 totally different global approaches to that clarity, starting with a significant step forward in the UK.
The UK has truly taken the lead in providing clarity. They passed the Property Act 2025, which has received royal assent.
And what does that do?
This establishes crypto as a new asset class under English law, completely separate from physical property or contractual rights. Legal experts are calling this potentially the biggest change in English property law since the Middle Ages.
That's monumental.
It's monumental for establishing clear legal pathways for ownership and asset recovery.
And when something becomes a mature asset class, the tax authorities are never far behind.
Absolutely. The UK confirmed the Crypto Asset Reporting Framework for 2026. This requires exchanges to collect customer transaction and tax reference numbers, just like traditional brokerages.
And they're expecting to make money from this.
HMRC forecasts this will pull in over £315 million in additional tax revenue by 2030. They are treating it like a normal, mature, taxable financial instrument.
Okay, contrast that regulatory embrace with China, which maintains a completely strict stance.
China remains highly restrictive. They recently reiterated that virtual currencies lack legal fiat status, stating all related activities constitute illegal financial operations.
And they singled out stablecoins.
Critically, they specifically warned that stablecoins enable money laundering and illicit cross-border financing. This is a sharp, fundamental divergence from the US and UK regulatory direction, which are largely moving toward integrating stablecoins into their official financial systems as legitimate payment tools.
We've covered immediate threats like AI, but what about the long-term, true existential threat to cryptography itself? We have to address the quantum problem before we wrap up.
This is the silent killer. It's years away, but requiring attention today. Quantum computing poses a fundamental risk to the public key cryptography underpinning Bitcoin and nearly every other blockchain.
So the threat is Shor's algorithm.
The threat is Shor's algorithm, which, running on about 2,000 logical qubits, could theoretically reverse engineer your private keys simply by looking at your public key.
That's a scary thought. How vulnerable is the existing supply of BTC?
Current estimates show about 6.7 million Bitcoin are vulnerable in one way or another. This includes about 1.7 million in Satoshi's initial exposed addresses and 4.8 million in reused addresses.
But the good news is we have some time.
The good news is that the timeline for concern isn't today. Critical quantum-resistant computers, the powerful ones, are currently projected to arrive sometime around 2035.
And people are working on this now.
That's why many teams are quietly working on quantum resilience and post-quantum cryptography solutions right now.
This has been a fascinating journey, jumping from BlackRock's balance sheet to the deep mathematics of quantum physics. The central tension right now is this massive, undeniable institutional embrace. Wall Street, Visa, BofA colliding with the relentless pace of underlying technological innovation, like Ethereum's Fusaka upgrade.
And this collision highlights a real paradox in the market. Most of crypto's valuation is currently a bet on crypto money,
Meaning Bitcoin.
plus a few select Layer 1 tokens. Even chains like Solana, which saw its underlying fundamentals and usage improve 20 to 30 times over in a year, have consistently underperformed BTC over the long term.
So even with all the engineering achievements we discussed today, Bitcoin's claim as the base crypto money is strengthening just due to institutional simplicity and brand recognition.
Absolutely. The valuations for many of these incredible Layer 1s are increasingly driven by a monetary premium. They trade at price to sales, multiples of 40x, 100x, sometimes 500x or more.
So they're not being valued like tech stocks.
They are being priced not as current cash-flowing software businesses, but as future digital currencies.
That brings us back to perspective, the main focus of our conversation here on Vocal Technologist. If you look at this through the lens of exponential thinking, which this technology requires, the entire sector could still be seen as incredibly cheap.
It's a different way of thinking.
The question for you, the listener, is this. Are you positioning your own knowledge and portfolio based on traditional linear Wall Street metrics, focusing only on current cash flows and PE ratios? Or are you betting on the long-term exponential potential that sees blockchains not just as a new asset class, but as the foundation that will eventually swallow all of global finance? Something to think about until the next time we take a look at the material.
Spoken Tech for your ears.